Welcome back. Today we're talking about Liberty Global. So they are a internet service, self-service broadband company in Europe. They own these individual companies that operate in different countries. So for example, they own Sunrise, which is in Switzerland. They own Telenet in Belgium. They own Virgin Media, I think that's in Ireland. And then they have some joint ventures, some 50-50 joint ventures, one of which is VMO2, Virgin Media O2, which is in the UK. So that's not what really got me excited about him, though. What got me excited about him was looking at the super investors holdings and looking at Seth Klarman. Okay, so Seth Klarman literally wrote the book on margin of safety, and he's one of the value investors I really like. I like listening to his lectures and stuff that I can find on YouTube. He's got them as close to 20% of his portfolio. Okay, so 17% here on the Class C shares. And then if you look down here, he owns about 3% of his portfolio is in the Class A shares. So the difference here is just voting rights. The company has said that they don't think that the shares should trade at a different price to one another. So just keep that in mind. I think either one's fine. But I mean, look, almost 20%. I'd said, yeah, right at 20, almost at 20%, 19.99% of his portfolio is in Liberty. That's crazy to me, okay? Because nothing else is even close. The next closest is at 10%, and it's been a big position of his for a while. So if I look at his history, it's been a top position going back to like 2019. It was his number one holding, and so that was 5 years ago. And remember, back on the chart, 5 years it's been down 40%, and that's just the stock price. The market cap's actually been down more than that because they've been doing so many share buybacks. So really interesting. We're going to get into it. I'm going to tell you, you immediately see the bull case and you're going to immediately see the bear case. The question on this company is like, which way is it going to go, right? So let's get started. First thing is this ordinary shares number. I mean, look at these buybacks. They were over 1 billion shares in 2014. Now we're under 400 million shares. Okay, so that's a crazy amount of buybacks. And to put that in dollar perspective, we'll go to the cash flow statement and look at the repurchase of capital stock. And you can see it's been roughly about $500 million a quarter in share buybacks. And just up here in the calculator, look, 500 per quarter is $2 billion a year. $2 billion a year in buybacks on a $6.4 billion stock. Okay, so just to put that in perspective, divided by 6,400, 31% yield on buybacks. What the hell is going on? Like, that seems so crazy. Like, what's the catch, right? And I'll tell you the catch. The catch is this: operating cash flow. Womp womp, okay? Going down. And what that does is it drives your free cash flow down. And if your free cash flow is going down, you're going to start running out of money to buy back stocks. And what that means is that you're really buying back, increasing your stake into a deteriorating business, right? So buybacks are great if the company's growing. I mean, it's awesome if the company's growing. It's good, and it can be great if the company's just flat. I think a good example of that is it AutoZone? One of those just really good buybacks has driven the stock price super high, even though the earnings haven't increased that much. But if you're buying back into a worse business, then that's not good, because now, you're by the time it's all over, you might own 100% of nothing, right? Instead of owning 2% of a huge company. So that's the danger. And another way to look at it is like, are they going to run out of free cash flow generation to where they can't buy back shares? And so that's the big question, right? Is this going to plateau, or is it just going to keep on dropping? And just to put it, kind of look at where we are today. Today, it looks like we're averaging about 200 million in free cash flow a quarter. So 200 million times 4, that's $800 million a year divided by 6,400. So that yield moving forward is a 12.5% yield. So really don't see how it gets higher than that going forward, unless they start dumping assets and selling things to then finance their buybacks, which they have been doing. So we're going to talk about that. But yeah, I mean, that's the big thing, right? I mean, it looks so attractive on that buyback side. And part of me is like, I can see which way it can go in the negative, and I can see the positive. But having Seth Klarman have it as 20% of his portfolio makes me want to lean way more to the positive side, just because, like I said, this guy literally wrote the book on margin of safety, and he's a respected value investor. Very interesting. So one thing I want to look at is, okay, let's say they do run out of free cash flow. Let's say they have some negative years or something. Is the balance sheet strong enough to keep the boat afloat, or do we have a bunch of liabilities that need to be paid and stuff like that? So I'm gonna pull up their balance sheet, not on the trend here, but like the actual balance sheet from the 10K. Okay, so this is from their 10K, and this is the year ending December 2023. Okay, so first thing I notice is that we have, current assets, 5.6 billion, and then we got all of these long-term assets. So whenever I'm looking at like a liquidation value or like a net current asset value or something, I'm trying to figure out, what do I want to count in my balance sheet asset box, right? Because if you have assets, a lot of times they're not worth what they're actually say on the balance sheet. Like they're carrying property and plant at $7.3 billion. If they went to sell it today, would they get $7.3 billion of cash? Probably not. Okay. Same with goodwill here. Definitely same with intangible assets, other assets. This probably does not equate 1-to-1 to cash. I mean, in fact, it definitely does not. Charlie Munger had a great phrase where he called some assets were something like great until reached for or something like that, or the assets were good until reached for. Basically, whenever you go to sell it, all of a sudden it's worth a lot less. So what I like to do is look at current assets, because current assets are going to be cash in a year. That's kind of the definition. It's cash is included here, some receivables, short-term investments, that sort of thing. And then I'm gonna look at investments as cash as well. So if I take that kind of liquidation value, a super harsh liquidation value, I'm not even going to count any of this. So I'm going to pretend like all of this other stuff is zero. I'm looking at 3.4, which is, not 13.4 plus 5.6. So 13.4 plus 5.6, it's going to be $19 billion of, let's say, liquid assets. And then going down to the liabilities, I'm going to count total liabilities. So that's what sucks about the balance sheet is like your balance sheet, the assets, some of them can be real and some of them can just be real until reached for, but your liabilities are usually always real. So there's not really any hope here with go to pay down debt and the guy's like, "Oh no, actually, you don't owe us this money," or something like that. Usually if this is on here, it's coming due eventually one day. So anyway, if I subtract 19 minus this 23, that's why I'm going to take the total liabilities. I get a kind of a liquidation value of minus 4 billion. Now, this is completely my way of doing it. It's just how I would intuitively look at a company. If you were buying a company, this is how I would do it. But it just gives me an idea of like what kind of position the company's in. I'm really looking for it to be positive. It being negative is not great. Now, maybe it's probably right at break even if you count some of this stuff as, if you give it a little bit of credit for these other assets. I pretty much knocked their assets down from 42 to 19. So that's a pretty big drop, but that's what I came up with. In my opinion, this lends more to the bear case, where if you ran out of free cash flow, you really might not be able to finance the buybacks, and all of a sudden you're stuck owning a big chunk of something that's losing money. Like that would be a nightmare, right? But going back to the news, what do I want to look at? The news release. Okay, so what they are doing, where is it? Okay, right here. Press release. So Liberty's going to be spinning off 100% of its Sunrise company to shareholders. So that's the Swiss company. And just another way for them to return value to shareholders. So I guess they're thinking and doing the right things, right? They're like selling or spinning off companies, using the cash to buy back shares, which they think is returning money to shareholders, except it's really about that underlying business. And that's the big concern, right? So let's just say I'm going to do kind of a crude valuation here, all right? Let's say that we do plateau here, and we plateau at about 300 million per quarter free cash flow. 300 million per quarter free cash flow would be $1.2 billion of free cash flow, okay? What market cap would that alone correspond to? So this is my DCF calculator. I'm going to put for that free cash flow $1.2 billion, 5-year growth. On a per share basis, it will be growing because they're buying back shares. So let's just say like 5% 5-year growth and then a 0% perpetual growth, okay? So that alone with a 15% discount rate and a margin safety of 2/3 means that the net present value is about $9.2 billion on that on this cash stream, right? And then the target entry price on 2/3 of that would be $6.2 billion, which would correspond to a stock price of roughly it would be roughly about $16.14. So, I mean, we're there with this scenario. So if you believe this scenario, you're buying something with a big margin of safety that has big upside. I mean, the net present value is 9.2, but it could be a lot higher on a per share basis if the number of shares is going down, right? So that's the big thing. For me, it's a pretty small position. I think it's a little too complicated, and I don't really like to go outside of the US, and I think that there are some big opportunities right now in the US market, especially as stocks have been coming down, but really keeping an eye on it. I'd love to know what you think about it. Please leave comments and tell me what you think, good, bad, or indifferent, all right? Thanks again. I'll see you next time.